all the central banks are starting to reverse the hiking cycles, right? So a lot of the headwinds that we had in 23, right, this tightening, the withdrawal of credit from corporates and businesses, that's going to start to get better, right? And so the first half of the year is probably still a lot of those headwinds. The second half of the year, they start to go away and it starts to get a bit better. There's really been a decoupling since roughly the summer between Asia and the rest of the world, where the trade data in Asia is starting to get better. And so the growth differential between emerging markets and developed markets will start to increase again, right? So in that sense, we're more optimistic from a growth perspective on Asia. There's a whole range of countries with important elections. The most important one being the U.S., right? The U.S. election is still later this year, I think would have a big impact potentially on markets.
Thank you for your time to attend our show.
Hi everyone, I'm Arend Kapteyn, UBS London.
Let's begin with the inflation. The recent data show that the inflation continues to fall. So do you think the inflation will go up again in the US and Europe?
I mean, it could go up in the monthly numbers, which we actually do forecast to happen. The monthly numbers are quite volatile. But I think the trend is unambiguously downwards, right? We've now reversed about 90% of the global run-up in inflation, if you look at the monthly sort of annualized run rates. And it's really across all the components. It's not just energy, food's coming down, goods inflation is already completely normalized, and even service inflation is now starting to come down quite strongly. So I think the big story for 2024 will be that we are going to land very close to pre-pandemic inflation levels.
Mm-hmm. The U.S. labor market performed much better than expected in December, while the U.S. economy headed for soft landing.
So the payroll number came in better than expected. I think it's a bit misleading in terms of how strong it really was. So if you take out the government sector and the healthcare sector, then on a 3-month moving average basis, private payrolls are barely growing, right? So there's a clear slowdown in the labor market. If you measure it through the aggregate hours worked, right, so not the number of people who are being hired, but the total numbers of hours that those people work, then the last 3 months, that's actually been contracting, right? So there's a real slowdown underway, I think, in the labor market, and you're running probably about half the level of employment growth that you had 6 months prior. So if you extrapolate from those trends and you sort of think, where are we going to be in about 1 or 2 quarters from now, then we think payrolls are going to start to contract. And so we have a very mild recession in the forecast. So in the middle 2 quarters of the year, we have a mild recession. Now, whether you call that a hard landing or a soft landing, it's technically a hard landing because it's a recession, but it is the mildest hard landing that you can think of. So in U.S. recession history, this would be the mildest U.S. recession.
Mm-hmm. What factors will lead to a mild recession?
So a few things. So this is going to be a very unusual recession in the sense that it's coming from consumption, not really from the usually volatile investment component. So the way we sort of think about it is that normally what happens in a recession, there's some kind of shock, right? It can be an interest rate shock or some exogenous shock. And then the volatile sectors of the economy, investment in particular, go down very quickly and everything else gets dragged down with it. That's not what's happening now. So we've had effectively already a recession in the investment sector, the housing sector of the US economy. That's sort of starting to stabilize a little bit, but now consumption is going to follow with a lag. And the reason it's following with a lag is because we had so much stimulus that has taken a lot of time to sort of use up all the extra money that people had to spend. And so having a consumer-led rather than an investment-led recession makes it a little bit milder. The other big factor, which is already sort of happening now, is that while we've had a very big hiking cycle, a tightening cycle by the central banks, that's going to start to get reversed. So we have not just the Fed, but every single central bank in the world, excluding the Bank of Japan, is going to be easing policy this year. And so we think that's, already if you look at the market pricing, that's reversing about 1/3 of the total tightening that's taken place. So that's going to start to reverse a lot of the headwinds that we've seen last year.
Mm-hmm. UBS expects the Fed will cut rates by 275 basis points. What's the logic of this forecast?
Yeah, there's 2 steps to it. So the first bit, which is only worth 75 basis points, is what the Fed itself says it's going to do, right? So the Fed has a very transparent framework. They actually publish forecasts, and in their own forecast, they have 75 basis points worth of, so 325 basis points cuts this year. And where that's coming from is they have a particular level of the real Fed funds rate, the real policy rate that they're targeting. That level has already been reached. And so as inflation now continues to come down, they're going to start to exceed that level of tightness that they were aiming for. And so just because of that, they're going to start to cut. Now, that's the first bit, and that's a small part of the cuts. Whether they do more than that, which they're not forecasting, is dependent on having a recession. If you get a recession, unemployment starts to go up, and then they have to basically react the way they normally would, which is they have to push the policy rate back below neutral. And in the case of the US, that's below 2.5%. So that's where we think we're going. But that last bit really depends on the recession, and that is not a certainty.
Mm-hmm. Do you still believe the Fed will begin cut rates in March?
Yeah, so that's our forecast, is that the first cut is in March. Now, the market is only pricing about a 50% probability of that. The logic of March is that by March, the real Fed funds rate is going to be running close to 3%, way above where they themselves had forecast that intended level to be in 2022. And so that's a logic for March. Now, in reality, you probably need some cooperation from the other data, not just inflation, right? So I think, they can sort of make two types of errors. They can cut in March, a small cut, and then end up being wrong, right? And so for that reason, I think they would be more comfortable if they saw payroll data weakening or other activity data weakening, or they could cut later and then cut faster, right? And so there's certainly a risk that they prefer to cut a little bit later, but then maybe cut faster, so that they don't, have, as they say, egg on their face, right? That they don't with the benefit of hindsight, have cut too early. So I think the market is sort of fairly pricing that. It's not a certainty that they go in March, but based on their own forecast, they should go in March.
What's the risk if the Fed cut faster?
I don't think there's a lot of risk to that, right? So with inflation dynamics being so clearly to the downside, our forecast is we're going to land below 2%. There's a lot of sort of what we call inertia in the forecast. If you look at the housing component of US inflation, that basically lags where the market rents have already gone. And so we know that up until late summer, the biggest part of core inflation in the US will continue to go down, right? The risk on inflation are more things like oil prices going back up. And that's always possible. But that's really not, I think, going to change the underlying dynamic. So I don't think that's a risk at all that they go too fast.
Mm-hmm. How about the European Central Bank? When will the ECB begin to cut rates?
Yeah, so we have that happening in April. The ECB is much less clear than the Fed because they don't have a clear framework for what is the trigger to start cutting. Now, if you view it through the same lens as the US, sort of the overall tightness of monetary policy, then in Europe, the real interest rate, the real policy rate will be at an all-time high level by May. So that's partly the reason for saying, well, they probably go in April. The reason they don't go earlier is because they would be the first, if you look at the calendar of the central bank meeting dates, the March meeting is actually ahead of the Fed meeting. It's not that clear that they would have sort of enough comfort or evidence in hand going into that meeting and want to be the first central bank to cut. It's going to be, whoever goes first, I think everyone else will follow. But it's not obvious the ECB wants to be the first. So we think April. The one thing that's a bit easier in Europe is that the economic data is awful, right? So in the US, you have some resilience in the economic data, but you have strong disinflation. In Europe, you have weak economic data and weak inflation. So in some sense, the decision is a little bit easier. The one element that they keep citing about being nervous about is wages. And the problem with being nervous about wages is that they're not going to get a lot of evidence the next few months that wages are under control, right? So wages look to be peaking, but they might want to wait a few more months just to be sure that that's actually happening.
Mm-hmm. Like you mentioned, the economic data is very awful in Europe. So how do you think about the Eurozone economy this year?
So we actually have a recession model for both the US and Europe. And they have the same recession probability, about 90%. But if you look at the actual data in Europe, you would look at Europe and say, well, Europe is already in recession, and yet we're not forecasting a recession. And the US is, look at the data, it doesn't look to be in recession, and yet we're forecasting it. Now, the reason we're not forecasting it for Europe, and we are for the US, is that in the US there's an enormous imbalance between spending and real income. So people are spending much more than the income that they have. In Europe, that's not the case. right? So in Europe, the starting imbalance is actually very, very low, but at the same time, consumer confidence is low. People are not spending. They're not using their excess savings that they accumulated. And so consumption is just much weaker than in the US. And so I think there's a different level of confidence in Europe. And where that partly comes from is that housing prices have declined sharply. But that's really having an impact on consumer behavior. The other reason is that Europe is in many ways like an emerging market. It is very open, very trade dependent. That is the weakest part of the global economy. And so they're more exposed to that than the US, which is partly why growth is so weak.
Mm-hmm. Will a deeper recession take place in Europe?
So we don't forecast that, but that's very clearly a risk. So what our forecast hinges on in Europe is that as inflation comes down, real wages go up and people have more spending power. And then consumption, which is about 55% of GDP, avoids the recession. I think what we're actually seeing is that, so inflation is coming down, real wages are going up, and yet people are still not spending. And so the logic of that not happening immediately is that if you're a consumer, your price levels have not actually come down. So it doesn't feel like anything has gotten any cheaper, right? So we economists always look at the changes, not the levels, but consumers sort of look at the levels and they don't necessarily feel much better than they did 3 months ago or 6 months ago. So I think that will come, but it may just take a little bit longer than we think. And then there is a risk of recession. We're not forecasting that, the ECB is not forecasting that, but it's possible.
Mm-hmm. It seems the global GDP growth will slow down in 2024. What's your prediction?
Yeah, so we have a slowdown. Our estimate is that 2023 global growth was about 3%, maybe 3.1. In 2024, we have 2.6, so we have that slowdown, really only coming from two economies, China and the US, right? Now, in the case of China, that is mechanical because sequentially we think things get better, but you don't have a repeat of the Q1 reopening bounce last year. The US is because we have a recession. If you look at the rest of the world, there's actually not a whole lot of movement in the data. Now, in part, the rest of the world is already weak, right? So at the median level, so if you look at the average country in the world, so not weighting it by GDP or anything, you just look at the average economy, it's growing at about 1.5% right now. That is historically weak, right? So when you do the forecast, we're not expecting that to get weaker. The other thing that's happening is that all the central banks are starting to reverse the hiking cycles, right? So a lot of the headwinds that we had in 23, right, this tightening, the withdrawal of credit from corporates and businesses, that's going to start to get better, right? And so the first half of the year is probably still a lot of those headwinds. The second half of the year, they start to go away and it starts to get a bit better.
Mm-hmm. UBS expects China's GDP growth will be 4.4%. It's lower than 2023.
Yeah.
Why?
That's because of that. If you think about the first quarter of last year, the end of zero COVID, the economy opened up. We had an incredibly strong first quarter. We don't have that happening again. We're not going to have as strong a first quarter as last year. But actually, the other quarters are going to be fine, right? So sequentially, we have things getting better in China. The property market, we think, starts to stabilize in the first half of this year.
Mm-hmm. What will be the key drivers for China's economy?
So the property market is the most important factor in a forecast that we're nervous about, right? When on the one hand, we look at all the announcements and an enormous number of stimulus measures by number has been announced since the summer. It's not yet obvious that that's fully turned the ship, right? So when we look at the monthly data on property activity, 1 month is up, 1 month is down. There's no clear sort of pattern yet or troughing in the data. We think we're getting very close to that, so we're becoming optimistic, but that is the single most important thing because it has all kinds of spillover effects. So that's the thing we're most focused on.
How about other industries besides property industry?
Well, so the bit that we're most excited about in terms of our outlook when we look at the equity market is really the tech sector, right? So the tech sector is now historically cheap compared to the rest of emerging markets and certainly compared to developed markets. And what's interesting when you look at the earnings trends in that sector, they've actually been improving, right? So despite the weakness that people see maybe in the economy as a whole or property, there are pockets of China that actually look very, very resilient. And the tech sector is the one that looks most resilient. So we like sort of North Asia tech as an industry, but within that, we particularly like China internet stocks.
Mm-hmm. Do you think which region will drive global growth this year?
I think on average, emerging markets are going to do a little bit better than developed markets. And so one reason is that so the weakest part of the global economy right now is trade, right? And that is really emerging markets. But that is starting to turn. And particularly if you look at Asia, there's really been a decoupling since roughly the summer between Asia and the rest of the world, where the trade data in Asia is starting to get better. And so the growth differential between emerging markets and developed markets will start to increase again, right? So in that sense, we're more optimistic from a growth perspective on Asia. Now, whether from a market perspective, emerging markets can decouple from developed markets, I'm much more skeptical. So if we have a recession in the US, it is very unlikely, with the exception of China, I think, that emerging market equity markets would not go down along with the US, right? So I distinguish a little bit growth from markets. They might behave in different ways this year.
Mm-hmm. You said that you prefer the bonds to equities in an interview. Why bonds will become more attractive?
Yeah, so, well, mainly because we're going to start to reverse a tightening cycle. So in level terms, yields they're not historically high, but they're certainly back to where they were, 15, 20 years ago. The central banks generally perceive themselves to be well above neutral levels. So as they start to go back towards neutral, the bond yields will decline, and so bond prices will rally. And so as an entry point, the market is already responding to that. But I think that is sort of the most straightforward thing this year, is that when inflation comes down, bonds do well. And that's the simplest thing to do this year. If you do anything, that's what you want to do. And equity, I think, is difficult in part because risk premia are so compressed, right? So if you go back in history and you look at how do equity markets perform in a year when credit spreads are this low, when volatility measures are this low, they generally don't do so well, right? So equity markets do well when your starting point is very bad and then there's something to recover from. But the starting point in this case is that things are not so bad, and then it's difficult to sort of do well. So for that reason, we prefer this year bonds over equity, but that's really sort of a recommendation for 24. It's not a medium-term recommendation. It's just a tactical recommendation.
But the S&P 500 performed very well in the past 2 months. How do you think about the US stock market this year?
Yeah, so the S&P 500 is really split between the Magnificent Seven, sort of the big tech stocks, right, and everything else. And the everything else is not doing so well, okay? So the earnings for the non-tech sector is, we think is going to be flat in the first quarter. It's severely underperformed tech stocks in the fourth quarter. So the S&P is this average of these two different parts of the economy. So now looking at what's going to happen this year, we still think the S&P will go up despite the recession, but not by very much. So what we think is going to happen, if you listen to our equity strategists, is that the market will, for now, continue to sort of go up. If the recession happens, there would be a drawdown, right? This always happens in recessions. And then there would be a quick recovery if the Fed starts cutting. And then by the end of the year, you're back above where you started, right? If there were no recession, we'd be a lot higher than what we're forecasting.
Mm-hmm. Do you prefer what sectors?
So right now, because we're worried about that recession, we prefer to be in defensive sectors, so things that have, or high quality sectors, which means firms that have a resilience to weaker demand, right? So that are not so sensitive to weaker demand. So in general, we like defensives versus cyclicals. So, healthcare stocks, utilities, things like that. That's sort of a general recommendation, not just for the US, but also for Europe. If you look at it globally, we're actually neutral on tech globally, but we like North Asia tech, we like China internet, so as we spoke about.
If the Fed begins to cut rates, will the emerging markets have more opportunities?
So I think in local fixed income, which is our favorite sector in emerging markets, so the way I'd frame that is, so emerging markets tightened more than developed markets, and they did it earlier and were at higher levels historically than developed markets. Inflation is falling faster in emerging markets, which is interesting, right? So everyone had an inflation shock, but it's actually correcting faster in emerging markets than developed markets. So what that means is that the central bank can reverse those tightening, the level of interest rates actually faster than the developed markets. And so that is a sector that's really going to outperform. So local fixed income, bond markets, we think is sort of the safest place to be in emerging markets. Equity, much more tricky, right? So emerging market equity, I identified a few sectors, but if you take the entire asset class, now when do emerging market equities outperform? It's when commodity prices go up, they're not going up. It's when credit spreads can compress, they're already very low, right? So it's when growth differentials improve. Yes, that's going to happen, but it's not that straightforward. And if the S&P does have a drawdown, so a correction because of a recession, emerging markets are going to go down more than the S&P. So that's, I think, the problem for equity. If you look at currencies, they actually look pretty expensive. So again, we'd prefer to stay clear of those for now.
To what extent will geopolitical conflicts affect the market?
You know, it's not having much of an impact, right? There's a war in Russia-Ukraine, obviously. There's a conflict in the Middle East. That's not had a big impact even on oil markets, which is interesting, right? So it's always a risk, right? I think oil prices going up is definitely one of the risks to our forecast. I think as a political risk, what's coming into focus is much more, you know, some of the elections that we have this year. So there's a whole range of countries with important elections. The most important one being the U.S., right? The U.S. election is later this year. It's becoming a major debating point, right? Whether or not we get a second Trump presidency, I think would have a big impact potentially on markets.
Will these elections cause black swan?
Well, that's sort of one of these, sort of the unforecastable, you know, the known unknown. It's not clear, right? So on one level, there's a lot of conventional wisdom around these U.S. elections where, you know, people say that if Trump wins, then it's good for equity and bad for bond markets, right? It's good for equity because people think they're going to get a repeat of the last time, where you get deregulation, lower taxes, things like that. But it's bad for bond markets because the deficits don't come down. But that's sort of a little bit simplistic because I think, you know, if you go back to 2016, when Trump was elected the first time, we didn't actually know at that time how aggressive he was going to be on tariffs, right? So I think the way his potential victory would be interpreted this time could well be different from last time when the markets rallied. So I think we have to wait and see. People are definitely nervous. I think, you know, there's a lot of conversation about what that would really mean. But that is probably the biggest political event, at least, that the market is going to try to trade this year.
What strategies do you have for our investors?
Well, so the main thing we've been recommending from a trading perspective is just to remain exposed to fixed income, although I think the market's taking a breather here because it rallied so fast in the fourth quarter. But that remains sort of the asset class that should be most safe, right? We also think that the correlation between bond and equities is going to turn back around to where it's been historically. We're much more defensive and cautious on equity. We're, you know, generally neutral globally on things like tech. We're also a bit cautious on credit because the credit spreads are so compressed that, you know, we just want to see where growth goes this year, and then I think you can start to go back into credit and equity and things like that. That's I think the biggest sort of the big picture recommendation.
So should we keep more cash?
Yeah, you don't want to. Yes is the answer, but you know it's very difficult to be very overweight cash, right? As we saw last year. So we've been cautious for a while, but if you weren't invested in the second half of last year, or let's say the last 3 months of last year, you would have severely underperformed the market. So it's very difficult for a lot of our clients to be too overweight cash, right? Because the market has a tendency of grinding higher and you don't want to necessarily miss that. So what you actually tend to find speaking to clients is that, and that's actually what our equity analysts are forecasting, is that we think the market could continue to go up until it becomes much more clear that there's going to be a recession. And at that point, everyone's going to try to get out through the same exit door at the same time. Right? Everyone wants to be overweight cash at that point, which is that's sort of, you know, why you get the big drawdown, because you get too many sellers at the same time. But, you know, you don't necessarily want to be overweight cash now, right? I think it's too early to be certain that we're going to get that recession. But certainly there's a role for being somewhat overweight cash at some stage this year, and it has a role in your portfolio.
All right. Thank you so much, Arend.
Thank you.